Recently, Tom Lee appeared on CNBC and made some bold statements about the stock market. He admitted, "I underestimated how strong this market has been." The takeaway: macro data is becoming less significant, and the real driving force behind this rally is the substantial amount of cash on the sidelines, an estimated $6 trillion. Many investors have been waiting for a downturn, hesitant to commit, expecting a recession. Yet, despite these fears, the market continues to defy expectations. October, which Lee previously predicted would be turbulent, is proving to be surprisingly strong. When asked to reconcile this with his earlier forecasts, Lee didn't shy away. He admitted that the market's resilience caught him off guard. He acknowledged that the rally is being fueled by a combination of sideline cash, improving inflation numbers, favorable macroeconomic data, and a supportive Federal Reserve. Even with inflation data coming in hotter than expected, the market hasn't flinched. This isn't because investors are clueless. It's because the primary forces driving this market are stronger than the usual macroeconomic noise, at least for now. Lee suggests that the influx of money into equities, from investors who've been holding back for the past 2 years, is a powerful driver. They're now under pressure to get back into the market, especially before the year ends, or risk falling behind and facing career consequences. However, Lee isn't dismissing potential risks. He concedes that certain major events, like a sharp spike in oil prices driven by geopolitical tensions or an unexpected rise in unemployment, could indeed derail the market's momentum in the short term. Additionally, if corporate earnings turn out to be worse than expected, it could have a temporary impact. Yet, despite these potential pitfalls, Lee remains optimistic. He believes that even if we experience a dip, the sheer strength of the rally will draw in dip buyers, thereby supporting the market. As for the upcoming election, Lee argues that the market has already priced in the possible outcomes. Whether Trump or Harris, as a placeholder name, takes office, the fundamentals supporting this rally are unlikely to change. He also points out that inflation, while not officially at the Fed's 2% target, is trending in the right direction. Factors like high shelter costs and auto insurance premiums are lagging indicators that skew inflation data upward, but realistically, we're much closer to 2% than it appears. Lee expects these lagging components to eventually catch up, which would further support the market's bullish case. Lee's view is clear. The market has gained so much momentum that it would take a significant, unexpected event to halt its progress. The Fed's path towards rate cuts is likely to continue unless there are dramatic shifts in the macro environment. But what if you're a long-term investor? Whether Lee's short-term predictions play out or not, history has shown that holding quality stocks over the long term usually pays off. Investing smartly, saving more, and having a longer investment horizon are the keys to building wealth. Over the last 15 years, despite numerous crises, the S&P 500 has delivered substantial returns. The bottom line is this: don't get caught up in the day-to-day swings of the market. Focus on the big picture, choose solid companies, and stay the course. This strategy will almost always outperform those who chase short-term gains. And if you want to dive deeper and learn how to identify generational stock picks, consider joining our community, where we teach advanced strategies and tools to take your investing to the next level. That's it for this video. See you next time, and remember to stay smart in the market.